Welcome back to Trader's Theory. Today we're diving deep into Chapter 2 of Mark Douglas's Trading in the Zone, titled The Lure and the Dangers of Trading. Trading offers immense opportunities and the freedom to achieve financial success on your own terms. But with that freedom comes a unique set of mental challenges that can silently sabotage your success if left unchecked. In this chapter, Douglas identifies 10 key problems that traders face. These problems are rooted in human psychology and are amplified in the trading environment. Let's walk through each of them together and explore how to overcome these mental roadblocks. The first challenge is the clash between external and internal control. In everyday life, we've been conditioned to control or influence our environment to get what we want. We rely on strategies to manipulate situations or people to align with our goals. But in trading, this approach is counterproductive. The market is entirely impersonal. It doesn't care about your goals or desires. Trying to control the market or predict its every move only leads to frustration and emotional distress. The solution? Shift your focus inward. Instead of attempting to manipulate the market, learn to control your reactions. Develop the discipline to interpret market information objectively and respond rationally to changing conditions. Next is the need for certainty. Many traders crave the comfort of knowing exactly what will happen next in the market. This craving can lead to overanalyzing charts, relying on countless indicators, or becoming paralyzed by indecision. But trading, by its very nature, is uncertain. Douglas reminds us that no amount of analysis can eliminate uncertainty. Instead of trying to avoid it, embrace it. Focus on probabilities, not guarantees. This mindset allows you to act decisively and manage risk effectively without being crippled by fear or doubt. Another major issue is the illusion of control. Traders often fall into the trap of believing they can predict outcomes or influence market movements. This belief can lead to overconfidence and reckless behavior, such as taking excessive risks or holding on to losing positions out of pride. Douglas's advice is simple. You cannot control the market. What you can control are your actions. Let go of the need to be right and instead focus on executing your plan with discipline. The market operates on its terms, and your job is to adapt to it, not fight against it. Fear of failure is another common pitfall. For many, the fear of being wrong or losing money can be paralyzing. It can make traders overly cautious, hesitant to take necessary risks, or reluctant to execute trades altogether. But in trading, failure is inevitable. Losses are part of the process. Douglas encourages us to reframe failure as a stepping stone to success. Each loss is an opportunity to learn, refine your strategy, and improve your skills. Accepting this reality is crucial for building resilience in the markets. The need for validation is another psychological trap that can derail your trading journey. Seeking approval from others or even yourself can lead to poor decisions, such as taking unnecessary risks to prove your worth or impressing others with your profits. True success in trading doesn't come from external validation, it comes from within. Focus on mastering your process, managing your emotions, and achieving consistency. The rewards will follow naturally. Now let's talk about ego. Ego can be both a blessing and a curse. On one hand, confidence is essential for making bold decisions, but on the other, arrogance can blind you to your mistakes. Traders with inflated egos often resist feedback, refuse to admit when they're wrong, and double down on losing trades to avoid acknowledging their errors. To succeed, you must set your ego aside. Acknowledge that the market is always right. Mistakes are not a reflection of your worth, but an opportunity to learn and grow. Another powerful emotion that traders face is the fear of missing out. FOMO. The fear of missing out drives traders to jump into trades impulsively, often without proper analysis or a plan. It can lead to chasing losses, overtrading, or jumping into trends too late. The best way to combat FOMO is to trust your strategy. Remind yourself that the market offers endless opportunities. Missing one trade isn't the end, it's just part of the journey. The need for instant gratification is another dangerous mindset in trading. In today's fast-paced world, we're conditioned to expect immediate results, but trading doesn't work that way. The need for quick profits often leads traders to take excessive risks or abandon their strategies prematurely. Patience is key. Remember, Consistency over the long term is far more valuable than short-term wins. Believing you know more than you do, the illusion of knowledge, is another trap that can lead to overconfidence. This belief can make traders ignore warning signs, stick to flawed strategies, or resist learning new approaches. The antidote is simple. Stay curious, humble, and open to continuous learning. The market is ever-changing, and adapting to it requires a mindset of lifelong improvement. Finally, the need for approval can undermine your ability to trade effectively. The desire to fit in or follow the crowd can cause traders to conform to popular opinion, even when they know better. Trading requires independence. Trust your analysis, stick to your plan, and don't be afraid to stand apart from the herd. Mastering these mental pitfalls is the cornerstone of trading success. Trading is not about predicting the market, it's about mastering yourself. By addressing these challenges, you can build the discipline, resilience, and mindset necessary to navigate the markets with confidence. So which of these problems resonates with you the most? Let me know in the comments. And if you enjoyed this video, don't forget to like, subscribe to Trader's Theory, and hit the notification bell. Together, we'll master the mental game of trading.